Hey guys, thanks for joining us. We're doing a webinar today. I was going to get together with Jeff anyway to go through some of my positions. I was worried with the market hitting those new highs. You might have seen me type on Twitter about I wanted to hedge some positions, and the best way to hedge them is with options. So first, I'll discuss what my concern was and why I wanted to lock up some profits. I've got some stocks that I'm up on that I bought just this year, like last month, the month before, that I'm up nicely. I'm into some key levels, and I'm not sure what to do. So whenever you get into this situation, it's a good situation to have when you're up on stocks and you're wondering what to do. That's usually a good problem. It's better than being stuck on something and wondering what to do. So we're going to go through three different examples, and then if you guys have questions on your own positions, if we have time, Jeff will review those as well for you. But the first one we wanted to review was DreamWorks. Now, I picked this one up right into support. I bought it in February 26th. My average is just under 17 bucks, 16.82. So it might have been right into this that big candle there when it was coming down. So I just wanted to show you that it was right around where these tweezers had formed. Okay, on the chart it's actually, I'll go exactly for you. It is right. I actually bought into that first red candle, so it's actually this candle here. Okay, but we just did these charts just before you guys got in, so I actually bought into here that day. Just before it dropped back, the tweezers formed. I was going to buy more into 16. I never did. So my average is just below this 17. Never really been down much on the stock. I was down for a couple days. After the third day, I was back in the green on it. So now it's come up to a very key resistance at 20 bucks. Okay, you can see today it's still holding quite well above the 200-day, above the 50-day. Now what do? On this stock, as of right now, I was going through it with Jeff just before we started. I'm up 14%, 14.23%. I've got a couple thousand shares, and Jeff's going to discuss what I can do with it. So I don't mind actually even selling into 20 bucks, but I know if 20 breaks through, I can get over that. I can get towards 22. So I can get up to this area, okay, the $22 area, as you can see there. So right now we have hit resistance. I'm up on the stock about 14%. My buy was pretty good because I bought into this the day where we actually it was just prior to earnings. We dropped back but held, and I didn't mind holding this thing because I felt 16 was going to hold well, and it did. So Jeff, what can I do on this? Do you want to switch over to your
Okay.
screen?
Yeah, let's switch over to my screen. Okay.
Okay, so I'll give you the screen. Go ahead. So Jeff, by the way, guys, if you don't know him, he's from our chat, but he also is a contributor to the newsletter that we have. So he's very, very sharp when it comes to options hedging. He's a well-rounded trader. Okay.
Okay.
Oh, so you
Can you
already
guys see
wrote
my
it out.
screen?
Nice job. Yeah, I can see it.
Okay. So I just wrote it out. That way, people can see it while I have this uh, uh, shown up to everybody. Okay. So that's good. All right. So first of all, good afternoon to everybody. Thanks for joining us. You had mentioned you had an ideal exit of 20. And I don't know if you mentioned it, but previously when we talked earlier, you said you don't mind adding on at 18. So let's do this. DWA um, reports earnings on April 30th. So that's something everybody has to consider. If you're long the stock, you want to know when all these big events are. And in your case, Frank, you said you don't mind getting out at 20. So my one way you could trade this is by selling the May 20 call. You could probably sell it for mid at 50 cents between the bid and ask. And basically, what this does is you take in the 50 cents, you're giving the right for somebody to buy your shares at $20 if it trades over 20 bucks at any point before the expiration of the May contracts. what that does basically is it takes you out at 20.50. So the strike price plus the premium that you took in. So what does that do for you? That basically gives you a return of um, let's see, this minus this, right? That's 368, and there.
So almost
That gives you
22%. Yeah, 21.8.
it gives you
Perfect.
about 22% by by selling that extra 50 cents, and it's basically you're saying, hey, I bought the stock at 1682. I really want to get 20, but I don't know if it's going to get there. I have a longer term horizon on it. So if I want it to be sold at 20, I could have somebody pay me to take it from me for 20. Now, of course, the risk is, like you said, if it breaks through 20, it can go up to 22. So that's where the trade off lies. So basically, it all depends on your trade thesis, your investment strategy on it. Frank said he's happy to get out at 20. So the theory behind this is if you're gonna get out at 20 anyway, why not pay why not get paid 50 cents to get out at 20? Okay? Does everybody understand that? Or
Okay, so if it hits 20, Jeff, it's like I'm getting out at $20.50, which is good. I'm happy with
yes,
that.
if it gets
If
sold
it
out. Now
doesn't if
obviously
it doesn't hit $20 within by May, then maybe if you can explain, does that effectively cut my costs down to 1632? But I'm locking
yes.
up the profit ahead of time. I get to keep that 50 cents, right?
Right. So if DWA is trading at 19.90 at 4 p.m. on the third Friday of May. Basically, you get to keep all that 50 cents, okay? Because nobody's going to exercise it. So that reduces your overall cost by 50 cents. So this brings it down to 1682 minus 0.50. You're right. Sorry. So that's your net. That becomes your basis cost already. Okay. Now there's another downside to it. What if it tags 20 tomorrow and then it drops back? What happens is most likely you're not going to get exercise, and you're probably going to be annoyed that you could have gotten your stock out at 20, but since there's a full 28 days tomorrow before this expires, you know you have a you have a decision to make. Either you close the whole position out, so basically you have to buy this back and then sell your stock, or you wait until the expiration in May. And obviously the risk is it could be at 2025 tomorrow, but then trade all the way back to 1875 in 30 days.
So as soon as it hits over 20, I'm taking out, Jeff, whether I like it or not, right?
No, no, no. It,
Or
it,
not really?
it doesn't mean that. It just means that I'm just comparing it now. If you just had stock right now and it hits 20 tomorrow, but you sold those calls today at 50 cents, you could be annoyed or you could be frustrated because, if you waited an extra day, you could have just sold your stock and not be waiting for this, because the risk is it could go to 2025, correct, tomorrow, and then between now and the expiration in May, it goes all the way down to 1825. So
Okay, so that's the worst thing that where it could get tricky,
yeah,
where you hit above that
that's where it can get tricky. But like you said, you have a longer term um,
viewpoint on it. Like I wanted to hold it as
viewpoint on it.
what I
So
liked about DreamWorks, guys, just so you get a little background. I like the fact that they're coming up with a lot of movies in the next few years. They're going to be doing more movies than they've ever done. They do good averages on their movie. I studied how much they make per movie, so I like that. I like what they're doing with Netflix. So I think they got a lot of stuff going, and that's why I wanted to pick it up in the first place. I like the content companies for especially with the internet movie business exploding in the next few years. So that was my whole premise on this stock, why I wanted to get it. So I told Jeff I'd be willing to buy more further down. I don't mind getting taken out and then rebuy back in case we have a fall back into May. Like say we have one of those years where sell in May and go away. I don't want to give up that 14% profit that I'm up this morning. And at the same time, I want to try and maximize my profit. So, Jeff, you had come up with a suggestion on it to maybe get rid of half. Then I don't. Then I delay some of that problem of getting taken out if that happens. Like if it hits above that level. So go ahead.
There's a few ways to do this. If you're worried about the upside risk, meaning the risk of missing out on a move from 20 to 25, what you can do is you can sell all your shares now. Okay, you lock in there, and and then you buy a 20 straight up call. Now, depending on when, obviously there's a time element into options. So you could buy the June 20, 80 cents. Okay. So basically what you're basically doing is you're locking up all your gains now, which is, how many percent are you up now?
Right now, 14.17%. So almost $5,000, 4,700 and change.
So let's see. EWA is at 1920. Okay. And your net entry initially was 1682. Okay. This. Okay, that's how much you're up. Let me clear that up. You're up $2.38 per share. All right. Another way of doing this is you could sell everything right now. You lock in 238, and you can invest 80 cents out of that 238 per 100 shares, and buy a June 20 call. What happens is, if it makes a move to 22 and a half, this will appreciate a lot, and then you can sell it into a pop into 22 and a half, or you could even sell the 22 and a half calls against it later on and lock in more profit that way.
So would I do it on the same number that I sold? So I got 2,000 shares, Jeff. Would I sell 2,000? Would I buy 20 contracts or just half if I wanted to just do half, like to do 10? Is that what I would do? Or it doesn't matter?
You. Basically, the way the numbers would work is, so 2,000 shares, right? So you're going to lock up 4,760, right? And assuming you buy it at 80 cents, so you're going to buy 0.80 times 20 contracts to cover all your shares. Oops. Sorry. Should be 80 cents. Should be 80 times 20. Yeah. So basically what you're doing is you're locking up 4,760, but you're spending $1,600
okay,
to buy June 20 calls in the with the hopes that it pushes beyond 20 into 22 and a half, and you'll profit on that move, assuming it happens before the expiration of June contracts. So this specific strategy that we're talking about now basically is you don't have, your max downside is $1,600. Basically, you locked up $4,760, and you're spending $1,600 of that, which brings you to about a net of $3,100. So basically, you put that $3,100 in the bank, Frank, and the most you can lose is just that $1,600. This way, you don't have to be worried about, a week from now, some research company says, "Oh, this company's a fraud." I'm not saying EWA is a fraud, but it takes out that risk.
Or they have bad earnings, or it turns out it's a flop with that Netflix. I see what you're saying. So I can't lose on this trade if I do that. I lock it up, but I still get that if we get a pop above 20 to that 22 as I showed on the chart, or higher to 23, say, then I would pick up that amount. So let's take a simple example. It goes up to $22. Very simply, those contracts at the very least, depending on how fast it hits to 22, at the very least are going to be worth $2. right?
They're gonna be, yeah, at the very least, I would say about,
Less.
$2.20.
Okay,
Something like that.
so less my 80 cent cost. So I'd pick up about a buck 20, right?
Mm-hmm. So a buck 20.
So
So
another $2,400.
you pick up 120 times. Oh, sorry. Yes. 120 times. You pick
So
up another
2,400.
2,400
Yeah,
bucks.
I did it in my head. I'm pretty good. Okay, so $2,400. Okay, and so this is a more complex strategy. It's just locking up your profit and then risking a portion of that profit
Yeah.
for exactly what I want, like a break above 20 to 22 or 23. It goes up to 23, they're going to be worth technically $3. If it hits 23, like say into the next earnings cycle, I could actually, those things could be worth $5. So depending on
Yeah.
how fast they hit, right?
That's correct.
Okay. But at
One
the
thing to
very
consider with
simple, I like to always go conservative. Whenever I'm doing even my risk to reward analysis, I like conservative. So let's assume that it goes to $22. I could pick up an extra $2,400 or more. Okay, I like that.
Mhm.
So then I
Okay.
on the total play I'd pick up 4760 plus another 2,400 at the very minimum if it hits 22. If it doesn't hit it, then I still lose that $1,600. Like if it doesn't go above $20 by June, so it's given me plenty of time to make it through this second quarter, and just in case it pops through at one time there through 20, then I'm risking only $1,600, and I've got my other money that I can trade anything else I want with, because I'm not risking as much. Okay,
That's another thing. Yes, you raise some cash, and you can trade something else. I mean,
okay, I
if
like
you
that.
if you're also if your thinking is that it punches through 20 because it has good numbers, better
Right,
than expected numbers, you don't have to go all the way to June. You can just go and pay up for these contracts.
right. So the 50 cents. Now, if I went with just the May, like into next month,
Mm-hmm.
that would again, like you said, reduce my price to 16.32, or I lock up that 50 cents if it doesn't hit over 20 by then.
Yeah,
Okay,
that's
so that's very
it's
simple.
exactly the same thing.
Any questions on that,
Basically,
guys, so far? So I know it's
basically,
geared to my trading, but Jeff can take some questions if you have time on your own trades. But just this is like a problem I always go through, like that I don't do. And Jeff was telling me I should be doing this all the time, especially because I have more money at risk and more money into positions. And this is like a perfect way to do that. So as you can see, so two scenarios: either sell the, buy the, I mean, sell the May for 50 cents, the $20 ones, or buy the calls for June for 80 cents. So either way, it reduces my price. The other way is a little bit more complex because it's you're risking part of your profit into another play just in case you do break through. But I have more time. It's giving me right till June, which is actually smart too. Okay,
yeah.
so let's
Just
go
just
ahead.
so everybody knows, the first one, it depends on money management. What's your financial? Yeah, each trader has different circumstantial financial condition scenario. So, um, if you have a longer term view and uh, you don't mind just waiting for this to hit 20 plus and um, without you know too much risk, then I would say it's called a stock replacement. Basically, you sell your profitable stock, your shares, and in place of it, because you're worried that do I sell now and then see it jump up another 10%, then you just buy calls, okay, and replace it. So that way you know what your risk is. With the stock holding, you don't know how low it can go. If it's trading at 19.20 right now, you don't know if 2 weeks from now it could be trading at 15. So you have that, theoretically speaking, you have a risk of $19.20 if you don't have a stop on it. With calls, you can still play the upside, and you know what your risk is, basically what you paid for. Now the downside of this is if DWA doesn't do anything and it just flatlines, and this will lose value as we get closer to the June expiry, and with time decay, as is with any option. So there's always a risk or reward to anything. Nothing is a freebie. Just remember that.
Okay, thanks, Jeff. The next one, guys, that we're gonna do. So I actually like the first scenario better, Jeff, because at least I pick up the 50 cents. I understand about locking up that whole profit. Sometimes I find if I lock it up right into a key level, psychologically I might not get back in. So that would be what I'd be worried about. If I did the May calls, the 50 cents there that you said, I actually might feel more comfortable with that. Because then I'm reducing my price 50 cents. At the worst case, I get taken out, which is a good level that I don't mind. So let's go to the next one, guys, or else we're going to run out of time. So I'm going to just show my screen again. So that was the first one. So see what happens. So if by May we're not over 20 bucks, I grab the 50 cents. If I go with the second option and into June we go up towards 22, I can make an extra 2,400 bucks. Plus I locked up 4,700. I do have that 1,600 at risk, but you can see you can make these plays based on whatever your scenario is. So again, these are based on stocks that I'm up on right now. That what do I do? Do I wait? Because Jeff had asked me earlier, he goes, would you buy more if it came to 18? And I said, yeah, to 18 I would. Under that I'd be a little bit concerned, because then I'd like to see what it does into 17 or 16. So, if it dropped back down here, as you can see, to that 200-day 18, I'd have no problem buying there, because look at that. That's such a key resistance a few times for us. So let me show you on here, and then we'll go to the next one. So I thought this webinar would be good because it gives you guys an idea what goes through my head with this stuff, and how someone like Jeff can offer some really good advice to play that differently. So see right here, resistance at 200-day. Initially we had resistance at 200-day, but as we popped through, we went higher, dropped back, 200-day support. So if it dropped back to 18, we should have support there. Breaks that down, then yeah, 17 or 16 very possible again, but I'd buy more there. Okay, so if that makes sense. I'd like to buy into 18, but I don't like it under 18, especially now that I'm up. Okay, so the next one, let's go to the next one, which is, whoops. Next one is Family Dollar. So another one, I picked it up into the drop that it had. So my average on it, I bought February 11th, so it was still above 56 when I bought. I actually picked it up a few times there with my, I bought a bunch of different shares, but I've got on this one right now 600 shares at 56.95 average. So I'm up 8% on this one. So as you can see, this one is a little bit trickier because we're right at resistance. We closed the gap. So Jeff had asked me, what do you want to get out of it? Today it actually hit over 62 briefly. And I said, I actually don't mind getting out even here or 63. My initial target, I wanted to get higher. Into 70 would be great. But right now, I actually don't mind here because it is a major level. It pops through. Initially I'm only going to get another buck or two out of it. Unless I want to hold it longer. So this one, I'm up 8%. It's a nice safe one. I've played many times this stock over the last few years, and I've never lost on it. So I've done very well, and I don't mind taking a smaller percentage. This is, for me, I consider a smaller percentage swing, but it hasn't been very long since I've had it. So I usually don't mind holding this one 2-3 months. But right now, I could either lock it up right now and I take 2,700 bucks in profit, because my average 56.95, or I can wait it out. So this one, Jeff, what would you suggest for me on this one? Because I'm on the fence on this one. I could go either way. Sell it all today if it doesn't break through 62, and I'm selling into resistance. And you guys can see over here, guys, what I did. And again, very simply, guys, whenever you're buying or selling something, see in this case here, was I buying towards support? Yes, I bought actually a little bit above support because I was buying as it was above 56 there, almost 57. But right now, if I sell into this area down here, am I selling into resistance? Yes. And two very simple questions a lot of traders don't ask is when you're buying and selling positions, are you buying into support or are you selling it to resistance? So that's why in this case here, I don't mind either way. Okay, I might not be able to get that price I got before, but I could even buy this one again at into this level here, into the 58.50 or $60. So I'm not going to probably get my 57 area again, but that's okay. I can buy a little bit higher as long as that level supports. You can see here it actually supported nice right at the 50-day, but I didn't add more there. Okay. So does that make sense on this one? We covered that whole gap. Okay. So you can see this gap that we had from here to here. Sorry, it's a little bit messy. Okay, so we covered that whole gap. Gap cover, resistance, key level, not quite at the 200-day, but I know another buck plus, and this will hit resistance at 63. Okay, so and we're overbought up here, as you can see. So quite a few different things that I look at. I don't look at just one indicator, one analysis. I try to look at a few things. So this is where I'm at on this one. I could take it or leave it either way today. Okay, so and it's good that it's actually hit again into resistance today while we're doing this webinar. So Jeff, what do you suggest on this? I'll send you back the webinar.
Okay. This one, we can be creative on this one. Hold on. Is it me now? Okay. All right. So, to be a little creative with this one, you have roughly about $1.50 left to your target price, right? About 63.
Yes.
Okay. So, my suggestion on this one is, and like you said, you don't mind getting back in at 50, 58, 57 and a half. You know, that's not a problem for you. The only problem I have is the June contracts aren't here yet. They'll probably show up once we go after OPEX. But I'm going to use July for now, and then you could just apply it to the June later on, if that's something that you feel comfortable. So you look at the chart after 63, you could expect it to, probably test the highs. Hold on a second. So you had your, the 63, we use different MAs here. It could probably get up to the next big level is whatever the high is of this one, about 64 and a half, 65, and then, there's probably air about 67 and a half all the way to 70.
Right, and that I don't mind if I miss the 70. I know that that's potential, and I've missed a big move like that before, but like I said, I've traded it so many times profitable that I don't mind on this one. I'm not greedy at all on it.
Okay. My take on it is, if you're just looking to look for 63, but at the same time you're willing to add a 57 and a half, I would $1.50 away. Okay, it's probably check out the June contracts on Monday when they come out. But basically, sell your shares, and that 150 or 140 that you're lacking, what you could do is sell the naked 57 and a half put, because like you said, you're willing to buy again at a lower price if it gets there. So you could look at the June contracts. Maybe they'll go for about maybe $1.20, and basically you just sell those puts, and what that does is whatever you take in, let's say you take in $1.20, okay, you tack that on to whatever exit price you have, let's say 61.70. 61.70 plus $1.20 brings you to about 62.90, close enough to your 63 that you wanted to get out of.
Oh, I like that. And at worst case, I'd buy it. I'd be forced to buy it lower at 67.
57 and
57 and a half. Yeah. Oh, I like that.
Scenario is you're committed to buy the 57 and a half, regardless of what it's trading at in at the June OPEX in that case. So that's how I would do it.
Okay, actually, I like this, Jeff. This one I like, because I'm on the fence on it, and I could take it either way. So wait for Monday to see. Should I still sell my shares and then wait for Monday for the June ones to come out? Or that's the tricky part.
That's the tricky question. Let's take a look.
I'm glad you're here today. So, guys, we opened this up today. If you came in late, Jeff's helping me with some positions that are profitable, and I've got different scenarios on different ones. So he's giving me what I can do with options on them by risking some of my profit again, or in the case of this one, trying to rebuy it again, lower at key levels that I like. Okay, but hopefully you're understanding this. If you don't worry. You might have to listen to this webinar again. But just to let you know, there's other avenues than just selling the stock and being done with it. And hopefully you can understand from the numbers he's showing there.
Yeah, that's the tricky part, because just looking at where the open interest is, I could see it if the market goes crazy and gets fear into it again. It could trade closer to 60 tomorrow, just by looking at the open interest on it. But I mean, it depends on how big your position is. You could probably take half off here and then maybe take half off on Monday if you want. Depends on what you feel most comfortable with, or at the same time, where you.
And then whatever shares I want to buy back, right, Jeff? So in the case I had 600 shares now, so I would only do like 6 contracts, right?
Yeah,
Okay.
yeah. If you
Okay.
only want to buy 600 shares at 57 and a half, just sell 6 contracts.
And that actually would bring me right back to almost where I was pricing wise, because I was under 57 on this last buy. So I lock up on this one, $2,800, over 8%, 8.24%. Okay, I actually don't mind that. I might even take that off. I might wait till tomorrow just to see, because what I liked was the fact that the one thing I've liked on this, I got the alert today when it hit over 62. I'd like to see how it closes. If it got into the highs of the day, I'd actually don't mind getting rid of it then. The thing is, today it might be setting up a shooting star, looking at my charts. If it does, then I might be better off to sell it today rather than wait for tomorrow. Because it is a key resistance.
Yeah, it's having trouble at this 62 and a half.
Yeah, you see what I'm saying? So it actually did drop back a little bit from the highs today. It seems like not a shooting star, a doji actually is trying to form today. But what I liked was it came back so strong, even with the market drop that we've had and the craziness that we've had the last few days. See how it actually held up good above the 20-day? So it's very possible that this can go over 63. If it does, then I could easily track my profit from there and trail it under 63, because then I'd be much more profit than I expected out of this trade.
Yeah.
So
makes sense.
Okay, I like that. That play though, Jeff. If I decided to keep it, let's say by tomorrow or Monday, it gets over 62, 63 again, could I still do just by itself and do the naked shorting of the puts there?
Of course, yeah. I mean, you could certainly do that. I mean,
and my risk is
because for everybody, you sell one put with a multiplier of 100 shares, naked, meaning not a put spread. You're selling it as is. You're liable to buy 100 shares of that stock at that strike price.
Right.
Okay. Regardless of where it's trading at come expiration. So in Frank's case, okay, I'm just going to give this example, not to scare anybody. If Family Dollar is trading at 50, all right, he has to buy 100 shares at 57 and a half. So right off the bat, he's down $750.
Right.
Okay, just know the risk. I'm not saying it's going to happen. Some people think it's free money selling. I talk to some folks. That's why I want to make sure that people here understand the risk management aspect of it.
In the future, guys, something to keep in mind too is right now those mini options are only geared for the Apple, Google, Amazon, GLD, and SPY. But in the future, they're going to roll them out to other stocks. That's something where you guys can do it too. Like right now, don't worry too much about the amounts because I'm doing it based on my shares. You guys will end up being able to do it on only 10 contracts, so you don't have to do 100 at a time. So instead of risking the last example where we took 1,600, you only risk $160. So say you had 300 plus profit on something, but you're willing to, or 400 and something. In my case, I was up over $4,000. If you want to take off $160 and protect something like that, that's when you can do it. Right now, you can't because none of these stocks have many options, but something to consider down the road. Or if you're doing Apple, Google, Amazon, then you could do it on that stuff too. I think Google's on there, right? On those minis.
Yes.
I know it's
Yes.
I have Google, Amazon,
Google
GLD,
has
and SPY. I think.
those,
Okay, actually, I like this one, Jeff. To buy into that 57.50, I'd actually feel good. I might go with that scenario. I've been making notes on what I want to do on these, and you can see how each one is different, guys. So, and for you guys, it's even different more because if Jeff knows how many shares you got and at what price, then it's easy to do it. So I'll try to work out something with Jeff if any of you are interested or you're listening to this as a tape version to see if Jeff can get together with some of you. I don't want the guy to do it for free, but you can see how much time it takes to go through it. But it could actually end up saving you or making you more money based on these strategies, especially if you understand the levels well, like I do. And even if you don't, and you're up on something, don't just think about selling it. Try to hedge if you can. And I know if I start doing that, Jeff's promised that I'll do very well with it. So you probably wish you could just trade my account and do all these exciting different plays on it. But I love that at least we're talking about it today. I've hesitated doing this stuff because I know what I like to do and what I enjoy to do. And this is a little bit out of my comfort zone, but I'm trying to force myself to do it. I've done it on other stocks in the past, but not on many positions. And that's where Jeff and the other guys in the chat are trying to force me to do it. So, okay, so let's go to the next one, Jeff, the last one, and then if we have any questions, people can ask us.
Yeah.
So the last one, guys. So you see on DWA, we went through that. I got to take the screen, yeah, before I make a mistake here.
Okay.
Okay, so here's my screen, guys. So you can see for Family Dollar where my concern is. I know I can go up to 70. I don't care about the 70, to tell you the truth, okay? I'm really worried about what it does right into here, that we're coming into May, and where I could take it. But I'd have no problem buying it further down. Okay, exactly what the levels we were talking about. I'd feel better 58.50, but 57.50, no problem. And it just takes me back to where I was before. So I lock up all that profit, and I'm back in again. So it's almost like I have the same position if I do that. Worst case, nothing happens. I keep that whole amount that Jeff was talking about. How much was it on that one, Jeff? Oh, we don't know yet till Monday, right?
Yeah, we won't know yet. I'm just basing it off of what my estimated number is.
Okay.
Just based off of how much the one.
So let's take an example, guys. Let's say what Jeff said, it's $1.20, and I end up doing 6 contracts. So $1.20 times 6, right? 600 is going to work out to, just so you know, the most I can make on that play. So 120 times, okay, so I make $720. Now, it doesn't sound like a lot, but see, I've got a lot of positions that I've held longer term. Now you start picking up that each month. That alone is a nice little amount, okay? Or even every other month. Like in this case, it'll take us up to June. There's guys that do this strategy on their positions and they get a nice little rent. I know that's the way you've called it, eh, Jeff? That you call it a nice rent each month on the positions you're going to hold anyway.
Yeah. No, for covered calls, yeah. I mean, 720 doesn't sound a lot, but if you think about it, Frank, 3160, and you really wanted to, get closer to 63 on it, but you're basically what you're doing as a trader is you're trying to wait for that extra $1.70, $1.60, but you have your downside risk of about $4 because you said you're willing to buy again at 58 anyway. So instead of waiting for that $1.70, why don't you just sell somebody a put that you're willing to buy anyway and make up about $1.20 of $1.60 that you're lacking by selling your shares?
Yeah, no, I understand
Basically, that bridges the gap.
And it's a little bit extra money in my pocket.
Mm-hmm.
Okay. Guys, so let's go to the next one. Okay, this will be the last one that we're going to do today. So here's another one. Those 3D stocks, as you know, I like those. I had done a little blog on those. And I started to isolate the ones that I wanted to buy. This one I actually timed perfectly on DDD. I bought it on March 21st, just below 30 bucks before it broke out. That day it actually continued higher, dropped back a little bit. Okay, so you can see actually the day I bought. Was I buying into support? Yes. I've been waiting on these for quite a while. So I own this one and SSYS. Now we hit into resistance, as you can see, not too long ago, last week. Okay, and I knew that I could try to get 40, 45 out of this thing. Okay, right now, still sitting with a nice average. I'm actually down on SSYS, but I'm up on this one. This one I'm up right now, 3,800 bucks, 8.5% average. Okay, even though it dropped back a little bit today, as you can see today, it dropped back, but we're still at support that 50-day. It could drop back to 30.50. It could go back up to 35. This one, I'd like to hold it longer. And I was telling Jeff I wouldn't mind even buying more into 30.50. So I'm more apt to buy more on this one if it drops back. Plus next week there's a conference on 3D printing. I was keeping that in the back of my head because April 22nd, 23rd, there's a big New York 3D printing conference. So I think there's going to be some news coming out there with different companies. Whenever that is, it gets more press coverage and then they start to pop up. We've seen it before with biotechs, with different conferences that are held, and you'll see stocks moving higher during that time because they make special announcements. And the way 3D printing going, there's announcements all the time. Anything major comes out, it should be helping this whole sector. So I like it more longer term, this sector, but I'm also up nicely on this one, 8.5%. So what do I do on this one, Jeff? Like I told you, I want to buy more if I can into that 200-day.
Okay.
I know that's an odd number, so I'm not going to be able to get the options there. But what do I go? 30 bucks, 31? Do I wait? And see, on this one, I wouldn't be happy at 35 bucks profit. If it goes to 35, I'd be happy at 40. Is that too far out for me to try and do an option play on this one?
No, for this one, it's actually not too far, just because
You want me to give you the screen again?
moves a lot. Yeah. Oh, hold on a second. Oops. Yes.
There you go. I just give you the screen.
Can you see this now?
Yep, very clear.
Okay.
If you guys can't see those numbers, guys, zoom in. You can actually zoom in more than 100%. So if you look at the top left-hand corners of your screen, you'll see a zoom in button. So zoom in if you want. Those of you that are seeing the tape version, you can't.
All right. So the good thing about 3D systems, this name, it moves a lot. It has a lot of premium, and because it does move a lot, it moves fast. So you can see, even for a stock 30 days out, let's see, $8, so over 20%, you're still getting 45 cents. 20% move is huge, and you're still getting good premium. That's because the markets know that it moves a lot, so that they put a premium on it because it can hit either direction in a jiffy. You can see right now the market is basically down a little bit, and it's down 4.7%. So in this case, Frank, how many shares do you have?
Hold on a sec. I'm going to look at my other screen here. I've got 1,500 shares, and I'm up right now 8.39%. My average is 29.82, so just under 30 bucks.
Okay. How much would you add at 30 or 29?
Let me pull up the chart again. Okay, so I don't have a full position. I can add another $16,000 worth. That'll bring me to about 60,000.
Okay,
at which level would you want me to buy more? Sorry.
30 or 29, whatever you said that level
30.
You said you're willing to buy more. So about 500 shares.
Okay. Oh, I'm looking at the wrong chart. Just what you're saying. I'm still looking at Family Dollar. I go 30. What's he talking about? Okay, yeah, 30 and a half. That 200 day. I'd be willing to buy more. So maybe I'd buy another say $10,000 worth. So what's that give me? Another
About
300,
300
400
shares.
shares.
Okay, so here's and you said you don't mind taking some off at 35.
At 35, yes. Well, I wouldn't
Okay,
be happy at 35. I'd really like 40 or higher on this because I'm willing to go with the. I know that it moves big, like you said, Jeff, and we're seeing that today. It's down 4%, 4.6%. I'm willing to offset that, but whenever I offset that type of risk to reward, I want to make sure I'm making more out of it. So if it does hit back down to 30, 50 or below, I'm well making up for that on a bigger percentage in this case. If that makes sense.
okay, all right. So you got a few ways to do this. We could be creative. Um, if you don't mind, so at 35 you wouldn't take any off, even a portion.
I could take off a third, but
Okay, so what we can do, one way to do it is you sell five of the May 35s, okay, at $1.45. Let's take a mid. Let's sell five, okay, and
so
then
again, these
you
aren't the
sell the
calls
ones
that
that
Jeff's
buy.
talking about. So sell
Yeah,
five, so at a
yeah,
dollar
sell five.
fifty. Okay.
Yeah, okay, and then you sell another five of the 30 puts, okay.
Oh, okay. So that gives me opportunity to buy at $30.
Mm-hmm.
It gives me the fact that if it doesn't hit 35 by
Mm-hmm.
May, that I'm going to be taken out at what 36.50 if it's a dollar
Uh,
50.
yeah, roughly.
But only
Here,
on
here,
five, but only on a third of it. So I actually make more than
yeah.
the 35. I make a dollar 50 more. So instead of
Mm-hmm.
selling at 35, guys, I'm selling at 36.50. And
Mm-hmm.
at the same time, we know if it does that, it's not going to hit 30. So
Yeah.
then I pick
So
up the extra dollar 75.
yeah.
Oh
So
wow, I like
basically,
that.
okay. So basically, come May, if it's over 35, you take in this amount, $3.20 times five, so that's about 1,600 bucks. Okay, it's either going to do one of the two. It's either going to be, well, it could be in between. If it's in between, perfect for you because you keep the whole thing, right? So it can't be both over 35 and below 30.
Now,
So
what if
you can,
during that time during May it hits both those levels? And does that screw me up both ways?
if it hits those levels but doesn't stay there,
Right. Let's say it sells off more tomorrow and it goes down towards 30. Then I'm picking up an extra 500 shares at $30. Then
yeah.
it, oh, and then
If
it comes
somebody
back up.
decides,
That's not so bad. Okay.
yeah, if somebody decides to put the contracts to you. Now, just think of the fastest way, or maybe the easiest way to think about this is basically you have a $3.20 cushion to the downside. All right, if if it tanks, basically $30, which is your strike price, reduce it by $3.20. That brings you to 26.80. That's your net entry on the 500 shares that you're adding.
Oh, I like that. Okay, so it gives me a lower average, but if it continues selling off under the 200-day, which I think it shouldn't, but if it
Mm-hmm.
did, and say we had another major market drop, I think that's what could cause it. I still like the
Yeah.
sector longer term. Okay, I see. I like that. So then I'd have a really nice average well below the 200-day,
Mm-hmm.
and then I could just sit on them. So I get more shares, but I get that
Yeah, and then and
buffer.
then
But I get that buffer, and I keep the dollar 50.
yeah, and then
Okay, I like
at,
that.
at that at that point, if you put more shares and you end up having 2,000 shares, then you could just keep on selling, you know, calls at 40 strike or 35, 38, further out, 30, 60 days out, and you'll be fine.
Now, see the power of this, guys. It doesn't add up to much. We have one guy in our chat. He was busy today in a meeting, or else we would have got him in for Dizzle. He actually did it on DRYS, which was a stock that we both held longer term. I'd made some really great money on it, but then I got stuck holding it as it was coming down. He took every opportunity whenever it popped to sell calls. He actually got out of the position by keep reducing his average price lower and lower and lower each month and each quarter. It would be better to hear from him exactly how he did it, but this is how where you could use it to your advantage. Technically, you can actually get your price down to nothing over time if you keep doing this and you're not getting taken out. So say you have a stock that's flat and you're going to hold it anyway, or it's going down, you have the potential to bring your price down way down, and you actually make money on that stock without it even ever hitting your average price again that you started out with. Right, Jeff? That's the
That's
way.
correct.
That's one of the big benefits, and that's what these guys are upset that I haven't done it on some positions. So
Okay, so let's see. Yeah, that's certainly the you know
so what
a
is
really
that
great
called,
thing.
Jeff? What's the name on that one? I don't know. Is that like, are you
Well,
bracketing?
basically,
Are you bracketing the
it,
trade? What are you doing?
well, it's not really bracketing the trade. I learned that during the crisis in 08, 09, where um, I said I want to buy GE at this price, but what do you call this? I'm worried that it might go lower. So I said I'll take advantage of at that back then the VIX was high, and the premium was a lot for selling puts. And I said if I'm willing to buy 1,000 shares of GE, a company that I was pretty sure wasn't going to go under then. Um, I let's hold on a second. Okay, so this was 09, all right? And I think I bought before the big drop, so I kind of had a big drawdown. I think I bought around $9.20. I bought um, 500 shares at $9.20, and then I also sold uh, 5 puts of the 9 strike expiring 9 months later. So I said, and I ended up I think selling them for about close to $1. So that's 10%. Um, and yeah, real money, it doesn't add up much. But if you think about portfolio managers or hedge fund managers out there, if they have, if the market had an 8% year and they had a 15%, that's huge for them. So I just try to have that mindset. I mean, everything is relative to your account. So 10%, you know, you're not going to get 10% in a bank. You're not even going to get 1% in a bank nowadays. So these things add up. You try to do this, if you can get 10% every 3 months, you multiply that by 4, that's 40% in a year. It hedges a lot of your losses that you could have on other plays that you ended up losing money. So this specific play, basically, yours is a partial covered call it's a customized uh, structure. There's no real play for it. I mean, there's no real name for it, at least that I know of. Now, in your case, you're probably gonna get a bang for doing this if you place that into earnings. And you know why? Because into a binary event, the options premium they tend to be juiced up because everybody wants to stake their claim. Is it going to go down? Is it going to go up? So the premium that you're going to get, $3.20, assuming BBD stays roughly around this level between now and earnings, 12 days from now, you're probably going to get maybe closer to $4, or maybe even more, 4.10 out of that same structure that we did earlier. Because what's going to happen is these are going to go up in value. These implied volatility is probably going to be closer to 100. So this 100%. So these are probably going to go up to about $2 and change, and this is going to go up to over $2. So you're
So
probably
you
going to
so
get
you
a
make
lot more
money.
than
So you make money
yeah.
before you even decide what you want to do, because that everybody gets more activity into these. It's like that volatility, like you said, goes up.
Yeah.
So on this
So
case here, guys, do you understand what Jeff's saying? So in this case, what he's telling me is sell both the calls. Okay, so and the puts. So I'm selling the calls at $1.50. I'm selling the puts at $1.75. I take that money in. It doesn't cost me that money. So when you're selling options, it comes into your account. All it costs you is some margin, but you're not actually putting that money out. That's money coming to me that I get to keep if these levels do not hit. If the level hits to $30 to the downside, I own 500 more shares because we would do only a third. I'd own 500 more shares at $30, which I'm comfortable with. Okay. In the case of it goes up to 35, what happens? I'm actually getting taken out at 36.50. So remember I said I wasn't too happy getting taken out at 35. In this case, I get $1.50 more. Now it's looking better to me. I said, oh, okay, that's not bad. At the same time, what happens? Plus, I picked up $1.75 on the call side, but only for 500 shares. I'm not willing to do this on this one for the full amount because I know it can go up or down very big. Okay, I'm still longer term that this sector goes up even more, but right now, I know that it can go crazy either way. Remember, there was an analyst that thought that this thing was a bubble. It hasn't been a bubble yet, but if it does break under the 200-day, then I'd have to reevaluate. But as a trader, that's what we're always doing. We're trying to analyze based on what we think is going to happen. Okay, and I understand levels. I'm comfortable enough with my chart reading abilities to make a decision on based on that. So it's nice that I'm up right now. How can I maximize that now or protect myself in case we get a big push up or a big push down? Okay. Actually, I love all this stuff that you told me today, Jeff. It's very different on each stock we did. Even though I'm up on all three stocks, it's a very ingenious way what you told me here. The other one, Jeff, that I was going to talk to you about, what do people do on stocks where they're down? Okay, so say I've got some dead positions. Let's take SSYS. I'm down on that just a little bit, 4%. I think it was 4% today. Let me check. I had been up on this one, but as of today, I'm down 3.1%, down $1,100. Can I use these strategies the same way to reduce my average? Sort of like what Dizzle did. Can I go month to month if I don't expect a big move or I don't care to get taken out at a certain level? Can I use the calls to my advantage to reduce my average?
Yes, the answer is yes. Now the type of structure that you put on depends on a lot of factors. Number one, how far down are you? Number two, um, are the options liquid enough? Some folks have, or if they even have options. Um, if there's some names that recognizable names out there, but the options aren't liquid enough, and it's tough to to um, put on positions at a decent price because there's not enough volume.
Oh, good
Number three,
points. Very good points.
what's the time horizon on it? For example, if you got into, let's say you got into triple D, you nailed this stop right here, 45, okay, and you wrote it down all the way to 30, and you're sweating, and then it bounced up to 35, and you're not sweating as much, but you're still sweating. Now your break even is 45, okay. Now what do you do? Are you happy at getting out of break even? Um, Depends on your financial situation, I would suppose. Uh, you could, I'm assuming it's a longer term hold because if you held through this drawdown, $10, that's 25%. Okay, a little over 25%, from 45 to 30. Um, you have to go further out. Um, you could sell the January 14, 9 months, 9 months. I mean, time flies if you're a trader, and even if you're a trader and working, um, you could sell the January 45 for $1.50. There's not much. It takes 9 months, but you're down. Um, you're down $13,
Right, right.
and you know, at the very least, you at least get $1.50 in exchange for getting back to break even. It's a tough call, but you're down so much. It's tougher to repair. If you're down about 3-4%, it's fine. Once you start getting into the double-digit percentage losses in stock, it's harder to repair. What I tend to do is say, you know, let's take this example and say you got in here instead. You got in at 35. So you're down roughly about 10%, okay, at 32 and a half. What, so you're down $2.50. What I would suggest in that case is you take your, just to get back to break even, you take your loss of $2.50, you get it back by selling the 32, okay? You sell it for $2.70. So it erases your realized loss in the stock of 250. You take in 20 cents, so you're up $20. Not a big deal, but it gets you back to break even. What happens is you're just committed to buy it at 30 cents lower. Okay? So if it goes up, yeah, you hit your head in the wall because heck, it went up and you basically nailed the bottom and got out at the bottom. But for risk management purposes, you could sell this 32 for $2.70. You get back what you lost already, and as long as it stays above 32, you're fine. So you're back to break even. You erase your 10% loss. So erasing a 10% loss for me is the same as getting a 10% gain. Um, and the worst case scenario is you have to own it at 32 bucks, which is 40 cents lower. Um, and and that's how you do it. And what happens is, if it trades over 32 and this expires, so you're back to break even, and you said, okay, I'm going to get you back, BBB. This is revenge trading, but and then what you do is you sell a lower strike again next month where you get in, and you just keep, if it's 100 shares, it's 100 shares, but you sell something for 310 or a strike price of 31. That's a 10% return if it expires worthless. Sorry, yeah, that is a 10% return. 10% of $31 is 3.1.
Yeah,
So
exactly.
you got to work the numbers somehow. You get and try to do it that way. If if you say, oh well, Jeff, I just want to keep the stock even though it doesn't pay me dividend. That's another factor for me. If a stock doesn't pay me dividend and I don't have a huge account, I tend to play with options a lot more and not do with the stock because it doesn't pay me to hold the stock. Why would I own it? Well, one way you can do by owning an almost equal amount of shares is just go in the money. So instead of shelling out, say, 2,700 bucks for 100 shares, sorry, 30 $3,200 for 100 shares, I'll pay up an extra 20 25 bucks and just buy this May 27th strike for $5.80. So I'm controlling, this is my delta, I'm controlling roughly 87 shares for a fraction of the amount instead of shelling out $3,200. And I'm controlling 86 shares. So that's another way to do it. Um,
Very nice, Jeff. I love this
yeah,
stuff. So, so what you were saying even earlier before, as the stock is coming down, let's take a worst case scenario. You start doing this strategy on a stock that continues to go down, company goes bankrupt. You've reduced your average, but at the same time, you're still going to lose a big pile of money. That's a worst case scenario. So that's
yeah,
why when you did it during that crisis time, I understand fully why you did it on GE because you knew GE, if anyone's going to survive, they're going to survive, which they
yeah,
did. You ended up making your extra 10%, and you didn't have to worry too much. You had bought under that key $10 area. You hedged
mm-hmm,
even more further down. I understand that fully. I hope you guys are getting this stuff because you can use it for your own positions. Don't do it on a high flyer. You can't do it like on a OTC stock or whatever. You're not going to find options anyway. Or like Jeff said, make sure the options have good volume too. On some plays, you might not be able to do this, but you can see on a bigger stock. And me and Jeff were talking about earlier. We both have Disney that we bought in 2011. I've had it for a long time. I got my average under $40. What was it, 39.26, and that one's up beautifully. And we've got a nice gain on that over the years. It's popped up nicely for us. that's one that you could do it on. If it ever collapses down again and you still want to keep it, then you just start doing this again. And at worst case, we get taken out, me and Jeff. Now, are you doing it on your Disney, Jeff? Taking that as an example. I haven't done
Um,
anything on mine, but I'm
I,
up nicely on it right now. Hold on, I'll
I,
tell
I,
you.
I, I did it 3 times on Disney, and you know, 2 of the 3 times I got called out, I just got back in.
Oh, okay,
Um,
so you bought back
and
in.
yeah, by doing covered calls. And this is, that's there's a risk reward. Nothing is a freebie. So if you sell a call, the stock could blow through past it, and you're going to be shaking your head. But it happens. It's the same way as selling. If Frank sold FDO at 62 and then finds out tomorrow that they got an upgrade and it's at 67, he'll be frustrated as well. So it's it's a similar scenario. One thing to also consider, and Frank mentioned, because I did it on GE, it's not going to go bankrupt. I mean, there are growth companies that, you're always worried about. Frank did a mini webinar on how to analyze the financial statements of companies. So you take that into consideration. And also, don't over leverage yourself. If you have $100,000 account, you shouldn't be selling um, at least from my perspective, you shouldn't be selling um, 10 of these because you're basically um, on the hook for 1,000 shares at $30. So that's $30,000, and that's 30% of your total portfolio. So and Frank also did a webinar, and I think you can talk to him privately as well on his mentoring sessions. With regards to money management. So everything is relative in this case. If you have $100,000 portfolio, and you follow the rule that no one name can be more than 5 or 10% of your total portfolio, then you could do one, maybe two of these. You could short 2 shares, and you take in the premium, and you're on the hook at the most for 200 shares. So it could be a
Actually,
speculative.
great point, Jeff. A lot of people probably miss on that. They might get excited saying, "Hey, if I do that on this many contracts, then I'm going to be able to pick up this." But you got to always look at, like Jeff says, look for a worst case scenario. Like look at gold. Who thought that it's going to drop as much as it did in 2 days? Never happened in 30 years, right? We've never seen stuff like in 2011 when the market dropped, or for those of us that recovered through 2008, 2009. Always want to make sure you're there for the long term. So, like the way Jeff is saying, with this kind of strategy, you'll pick up a little bit extra money on the sidelines, especially if you're at a point like where I am on these type of plays. You're up on them, and you can see my downside risk and potential what I'm going to lose, even if it works against me, is not so bad. Or I could own that stock back to where I had it before. So you're not you're not really hurting yourself too much. And see how even Jeff suggested, just do a third of my position rather than the full amount. I could do those big amounts, but I'm very big about money management on all my positions because I know I've had stocks that have gone bankrupt. I've had stocks that have gone down quite a bit, and be stuck on them. But it's never going to hurt me to put me under unless the whole market tanks completely. Then I'm going to get hurt. But I'm hoping during those times I got more money on the sidelines to take advantage of it, or I'm able to hedge that there's a bigger drop and I make some money on the downside. So back to Disney, guys. That example, I'm up 53% on that. So I'm up over 31,000, but I've had it since 2011. My average is just under $40. That's something I could look to do on that one because I don't think Disney's going to go under. I bought it at a time when the market was very weak, and I like the story behind it with all the content and very similar to what we said about the DWA. And plus, they have so much other income from TV, from the parks, and I was very safe to do that one. So I almost used that same analogy what you said with GE, Jeff. I didn't
Mm-hmm.
do the options on it, but I wanted a stock during that time that's not going to go under if something bad happened.
Yeah, and Disney's a good stock to own because it pays a dividend. So you get compensated for holding the stock. That's always been for me. I have a sub $100,000 account. and that's why I learned options because it gives me capital efficiency. If I wanted to own all these names, I'm going to run out of money
Yeah,
to
and
buy them.
you can't,
And
and I can't even own every name, Jeff. I'm not a hedge fund, but I got a bigger account than most people. But it's amazing how you start throwing enough money out there, and you can't possibly pick everything up. And even the hedge funds don't do that. They focus on certain sectors and certain stocks. So even those guys can't do it all. So this
yeah,
is an important thing, guys. You can do it as a very small trader, as Jeff told you. You can't do it if you got a very tiny account, but
yeah,
uh, if you're a mid-size to a bigger trader, this is something that you definitely need to look at. And I'm focusing on it. That's why I wanted to share it today, because I was going to be doing this with Jeff anyway. I thought maybe some other people get some benefit out of it as me and you are talking. So we didn't plan the webinar. We knew which stocks we wanted to discuss, and we only went through them this morning. It's not like we planned this webinar to say, okay, let's look at this, because the levels are changing all the time. These option prices are changing all the time. The levels are changing, but we thought today to do it, especially the week after the market hits all-time highs. This is at a time where I'm looking to protect profits. At the same time, I want to buy some lower. I don't mind if I get taken out on some, and some I don't mind to keep them longer term. But so you can see the decision was different on all of them. With Jeff, I had suggested them if any of you guys have questions on your own positions, then maybe you can contact us on the site and we'll try to figure something out, or have
that's
private
fine.
mentoring with him or something that he goes through your positions and says, okay, this is what you should be doing here. This is what I could suggest on here, and see how it helps. It's always still up to you to make your decision. We don't trade people's accounts, but learning this type of stuff, guys, will put you ahead of most other traders for sure. And I'm always constantly trying to learn different things. I've been at trading many years, but I'm constantly learning, and these are strategies I don't often use. And hopefully you got something out of today. I'll show you the. I'm just going to switch over, Jeff, unless you had something else to say. I don't want to keep it
Okay.
too much longer. But if you guys had. Hold on one sec. If you guys have questions, you can actually contact us here at the site, StockGuy22. So just click contact and just put what your questions are. If you have a question for Jeff about a position or something, let him know. But make sure you tell him what stock you have, how many shares you have, what price you're concerned about, and we'll forward it to him, and he can get in touch with you. We'll see if people are interested in mentoring, then maybe we can look at that. I might be doing some mentoring into May for stocks in general. But if somebody's interested in about this stuff, this is something that if you take your time and you look at it properly, you can see that there's another income to be made from it. The other thing too, I wanted to just point out, Jeff is a participant in our newsletter. If you guys are interested in that, we actually have. If you sign up, even as a free membership, you can actually download the past, the first 6 newsletters. You can see we do one every week. Jeff will go through option strategies on different positions that are coming up, earnings related. So you can actually just click on one. Take, for example, here, I'll show you what it looks like. So for those of you that are interested if you liked what Jeff said today and you want to learn more about his strategy, and he's got more strategies like this, but it's good to see what he's about. A lot of people know me, but they might not know Jeff. And I pick Jeff's brain all the time. Jeff's brain. I didn't even say it right there, Jeff. Okay, but here's an example. Let me get to Jeff's part. I think it's further up. He's just under a thing. So I'll give like different trade ideas. So I actually tell you long this stock, stop out at this point, go the long April calls. So you're actually giving ideas that you can actually use. Okay. And we're doing it every week, guys. So it's very specific. So if you want stuff from Jeff, if you like what he said today, check into the newsletter. Okay. Or you can actually give us a call and say, hey, or contact us and say, can you give me the most recent version? I want to check it out to see how you guys have done. We've got some really good hits that Jeff's done, that Rob's done, that I've done. I do a section on it as well, and I'll take different stocks and analyze them. You can click on the different charts and see what I did. Okay, this is about the online gambling. I made very good money on these plays, 16 to 30%. But I actually go through them of what I did and how I played them, the reasoning behind it. Okay, and I'll look at different sectors that I'm interested in, or different stocks, and give you a different perspective each week that you wouldn't see in a different like in a different light. I like that the other guys contribute so much, okay, because it's stuff that I don't trade, but it's stuff that a lot of traders might find interesting, and like with the futures and the stuff that Jeff does. So hopefully you guys got something out of this today. We'll see maybe if there's any questions. But again, somebody had a question, Carmen, I think it was you. Yeah, it is being taped, so you'll get access to it. For members, they'll get access to it, so you can listen to it again. And Norman had the same question as well. Do you guys have a question on a stock that you want Jeff to go through, so you can see how it's just based on something that you guys have done? Do you have any stocks that you guys are up that you want to review? If you do, and you don't, maybe if you don't want everybody to know about it, then send it as an email. If you wanted to review it here, type it out saying I got this many shares of this stock and I'm worried about this price, or I'd like, what can I do with it? And Jeff can do that. If there are no questions, then we'll end it for the day. I know there's a lot to take in on this stuff when you come into some complex strategies, but hopefully Jeff put it in a way that you didn't find it too confusing. Okay. But you can see you can make a little bit extra money. You're creating your own little cash flow out of the positions you're already holding, or you can buy back again by locking up your profit and then doing the options so you get back in, like selling those puts. Jeff, anything else that you want to mention? Oh, maybe we lost Jeff. Test. Or did you guys lose me?
I'm sorry. I usually mute my stuff so that you can.
Oh, you muted? Okay, so you were talking to yourself.
Yeah, I was talking to myself. So no, just these are good strategies, especially the covered calls. People take it for granted, but if 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 you like a company, but it doesn't, there's a lot of motivation to do this. One motivation I have is I like the company, but it doesn't pay me a dividend, so I'll write a covered call. Um, if it can give me 20% in 60 days, I'll be happy with that. Um, so these, rinse and repeat. It's not a lot, real dollar wise, but if my mindset is, if I were to put $10,000 in a bank, is it going to get me 20% in 60 days? And the answer is no. So I'll take that. Yes, there's a risk, but as long as you know how to manage your risk, you'll be fine with this. And like I said, I have losers. I went, short-term trades, whatever it is, I have losers, and these help, cover those up, and basically reduces my the red ink on my P&L. And even if for that purpose alone, I'll take it, because then I'll have the winners that I could take home with and feel good about. So manage your risk. We don't have a free window to the Fed like all the big banks, so we need to manage our risk. And if you can generate an extra income by managing it and reducing your average entry, it goes a long way.
Hey, Jeff, thanks again. I appreciate it. I know you took the time today. We weren't sure if we were even going to do it today, the webinar, but glad you guys got something out of it. I saw some of the comments there. Yep, Carmen, I'm glad you found it as good info.
Yeah.
You should do a few of these. Yeah, well, see, it was more like to help me out. And I thought, people are going to get something out of it. Maybe they can digest it, think about it, and say, okay, now I can see how I could use it for my stuff. Okay, but just know that it's possible, and know that there's people out there that are willing to help out. Like, you can go research all this stuff and find about the covered calls, find about selling the puts and stuff yourself. But it's nice to for me, I already know that stuff. I've studied it. But when I get someone like Jeff that does it all every day, for him it's like a no-brainer to go through this stuff. For me, it takes a little bit more. I'm better probably at the chart reading and taking
Yep.
profit on stocks, but I'm not good at this. So I know where my where I'm not as good at. So what do I do in that case? I want to learn from people who do this all the time. I don't want to read by someone that just did a blog about it. I want to learn from someone who's actually doing this day in, day out. Regardless of his account size or my account size, the strategies work. So if they work for him, they'll work for me just a little bit bigger. Okay, and it can work for you guys, regardless of your account size. As long as it's not like, you have, somebody contacted me the other day. They got $3,000 to trade with. Well, $3,000, you're not leaving yourself too many options of what you can do. They said, how should I manage my money? What should I do? And, if you have too little, then you can't apply this kind of stuff. But if you got a decent account, then this is definitely stuff you got to be looking at. So,
Mm-hmm.
thanks again, Jeff.
Totally agree.
I'll stop the
Okay, no
recording.
problem.
And
It's good to be here, and what do you call it? It's actually good because this is something this is an exercise I go through day in and day out anyway. So it's good to have this in a recorded format, and people can go back and sometimes I talk too fast, and sometimes I assume that folks understand what I'm talking about because it's something that's so familiar to myself. So it's good that this is being recorded, and then people can go back, and then if they have any questions, they can contact us in the future. So it's all good. And Frank, I think somebody just, yeah, I think it was Carmen. Do you have an idea when this will be uploaded?
I'm gonna see if I can actually put it onto to YouTube if I can. If it's not too long, sometimes that's the problem with YouTube. If it is, then I can put it up today. So, and
Okay.
if you want to follow Jeff, guys, that's his link there on Twitter, Cerebral Trades. Okay, so if you want to follow him there, that's where you can follow him as well. All right, guys, I'll end today's webinar. Thanks for coming out and think about the stuff that we talked about today, and I hope you found it helpful. Thanks again, Jeff.
All right. Thank you, guys.